Good morning from sunny Lake Tahoe. This is the free minute for June 30th, last day of the first half of the year. Uh, let's dive right in because we have a lot to cover today. First things first, the Giving USA report came out last week. Overall, giving is up 6.3%, 3.3% adjusted for inflation. The biggest risers were individuals, up 5.1% adjusted for inflation. That is extremely, extremely good news. Also, corporations up 6%. Worth noting that a lot of 6%, a lot of the corporate donations are in-kind donations from drug companies. So not that those are bad, but it's a little bit of a different mechanic. Other news happening around the country. Doge loses control over government grants website, freeing up billions, according to the Washington Post. Grants.gov is back online, and individual departments and agencies are being instructed to post their grants there without going through Doge. So those of you that are looking at federal funding may see more of that start to move very quickly. Very interesting dynamic in the economy right now. It is really a tale of two cities. On one hand, there's been a Wall Street rally over the last week, continuing into this morning. The S&P 500 and NASDAQ are near or at all-time highs as of June 30th, which means stock giving, donor advised fund giving, foundation endowments, right? IRA giving, because a lot of that is invested in the stock market. This is better than any time at any point in history to get these gifts. Please go after those. We'll talk more about it in upcoming webinars and other things, but if you need any help on that, please let us know. Why is this happening? Generally, AI enthusiasm, hopes for Fed rate cuts in the second half of the year, a pause on Canada's digital services tax boosted tech stocks as well. Now, meanwhile, Business Insider published an article that says three signs the economy is in worse shape than we thought. Why is this? Well, it turns out that for potentially lower income folks or folks not in the top 5% or not heavily invested in assets, things may not be quite as good. First, three facts here. One is GDP in the first quarter was revised down, so it was actually a negative quarter and even worse than expected. Personal income in May went down. It's very rare for personal income, excuse me, not personal income, personal outlays and personal spending to go down, although inflation is still in a pretty good spot, 2.7% year over year. We're also seeing continued claims for unemployment benefits, which measures how many people receiving those benefits have renewed them in the previous week. These have been steadily climbing for the past few months, reaching almost 2 million for the week ending June 14th and hitting their highest level since November 2021. Now, why is this a big deal? Well, generally, what's happening here is that folks who are not getting jobs are not finding them, who've lost their jobs are not finding them again, but we're not seeing a simultaneous increase in folks getting laid off. And so it's very interesting that if you have a job, people aren't necessarily losing it, but folks that don't have jobs are having a harder time moving back into the market. Now, last big thing is that the Senate is right now voting on the so-called Big Beautiful Bill. Couple things to call out here. One, there is a charitable tax deduction for non-itemizers. We'll keep an eye on this. There will be some minimum donations to achieve this if you don't itemize. Other big things to see, the individual standard deduction has gone up as it has for married couples. That will mean even fewer people are itemizing deductions. Now, on the flip side, the cap on deductions for state and local tax. So those of you that are in California or New York or Massachusetts or Rhode Island or New Jersey or places with big property taxes, which are the local tax component of it, that may shoot people back into the itemization category as opposed to the standard deduction category. Now, why do we care so much about this wonky portion of tax? Well, it turns out that when people are itemizing deductions, it makes it cheaper for them to then make charitable deductions because they are getting a tax benefit on their gifts. When they are not itemizing deductions, they are mostly not getting a tax benefit on those gifts, which is what makes these non-cash gifts where you can save money on things like capital gains taxes even more important, or QCDs, which have a bunch of tax benefits, even for non-itemizers. So this is a thing we will keep an incredible eye on. But really the big question is how many people will be itemizing their taxes in 2026? And that will affect giving to a considerable degree. There's a lot of evidence that the 2017, 2018 tax changes had a depressive effect on charitable giving. So we'll keep an eye on this. But overall, good news from Giving USA, good news from the stock market. Keep pressing on these major gifts and have a wonderful, wonderful week.